The dollar machine tightens, liquidity drains, FX snaps, and silver becomes the casualty. This is not a silver story, it's a dollar story wearing a silver mask. The crash from $83 to $75 isn't random, and it isn't just technical sentiment or a few big players leaning on the bid. It is the visible spasm of a much larger mechanism. When the USD funding system tightens, everything that relies on abundant collateral and cheap balance sheet gets repriced downward, fast, ruthless, and without apology. Recent estimates put the notional value of global FX markets at roughly trillions of dollars of turnover per day, and the dollar sits in the middle of that river like a gate, not a participant. When that gate narrows, the shock doesn't stay in bonds or stay in currencies. It transmits into volatility, into credit spreads, into commodity financing, into the paper claims that sit on top of precious metals. And then you see it in one place where people still believe safety is supposed to live, silver and gold. This moment is predictable because it is mechanical. It is not a mood swing. It is the next phase of a mathematical pattern that repeats whenever a reserve currency is used to finance an expanding web of promises that eventually becomes larger than the collateral base meant to support it. The pattern always begins with a setup that looks boring and stable. A system is built on a foundation that feels permanent, a currency regime, a collateral hierarchy, a set of institutional habits, a belief that the rules are fixed. Then comes expansion. Credit grows faster than real output, leverage becomes normal. Policymakers and markets collaborate unintentionally because incentives align. Borrowing is rewarded, rolling is easy, and the cost of capital is artificially tamed by credibility, by repression, or by the psychological comfort that the reserve issuer can always provide liquidity. Over time, the currency's role shifts from being a unit of account into being the lubricant of a global machine. The machine keeps expanding because it can until it can't. At that point, the crisis phase arrives not as a dramatic announcement, but as a sequence of small failures, auctions that clear only with concessions, funding spreads that widen, FX basis that stops behaving, temporary facilities that become permanent, and hedging costs that jump like they've been shocked with electricity. In that phase, control is lost in a specific way. Not because officials don't have tools, but because every tool has a mirror cost. Provide liquidity and you weaken the currency's purchasing power. Defend the currency and you starve the system of liquidity. Finally comes the inevitable outcome, a reset in the relationship between promises and collateral. Assets get marked down, claims get questioned, and the market starts ranking what is real versus what is merely written. If you want proof that this mechanism isn't theory, you don't need a textbook, you need history. 2 episodes are enough to show the same structure under different flags, different slogans, different decades, yet the same underlying math. Start with the United States in the early 1970s. The setup was Bretton Woods, a post-war arrangement that made the dollar the anchor of global trade and reserves, convertible into gold at $35 per ounce. That convertibility wasn't just symbolism, it was collateral. It was the promise that the unit of global settlement had a hard constraint. The foundation felt stable because the world wanted it to be stable. It was exhausted from war, hungry for rebuilding, and willing to hold dollars as the price of order. Then the expansion phase took over, quietly at first. The U.S. ran persistent deficits, fiscal, external, and political. The Vietnam War and the Great Society programs pressured budgets. Dollars accumulated abroad, especially in Europe. The Eurodollar market, offshore dollar banking, expanded the supply of dollar credit beyond the direct control of U.S. regulators. That was leverage layered on leverage, promises sitting on top of promises, with gold sitting underneath as the supposed backstop. By the late 1960s and early 1970s, the math was getting uncomfortable. Foreign central banks and institutions held growing dollar claims. U.S. gold reserves were finite. The foundation was still convertibility, but the expansion had produced more claims than the base could honor at the fixed price. That's the moment when the system enters the crisis phase. It didn't need a single catastrophic default to prove the point. It needed stress and doubt. Confidence became a tradable variable. Nations began to test the window. The market began to notice the mismatch between paper claims and physical metal. Then came the decision in 1971, the Nixon shock, the suspension of dollar convertibility into gold. It was framed as temporary. It never was. That was the admission that the system had crossed the line where discipline was no longer politically tolerable. The loss of control wasn't about incompetence. It was about constraints. Maintaining convertibility would have required internal deflation, tighter credit, a recession deep enough to reduce imports and restore balance. That choice was available on paper. It was not available in politics. Once convertibility ended, the inevitable outcome phase began, again, not as a cinematic collapse, but as a repricing of the entire monetary world. The 1970s saw inflation surge, with stagflation as the signature, weak growth and rising prices, a nightmare for traditional policy models. Bond yields rose. The market demanded compensation for inflation risk. Volatility climbed because the anchor was gone. The unit itself became uncertain. In precious metals, the distinction between paper pricing and physical demand became stark. Gold repriced upward dramatically over the decade, not because people got excited, but because the world relearned what it means when a currency's discipline is removed and replaced with discretion. Silver moved too, eventually violently, because silver isn't just a monetary metal, it is also an industrial metal, sensitive to growth fears and financing conditions. In inflationary regimes, physical premiums emerge not out of superstition, but out of delivery constraints. When more people want metal as a balance sheet asset and fewer want to part with it, you get inventory drawdowns in visible warehouses and tighter spreads in the physical market. Meanwhile, paper claims can multiply far faster than bars can be produced or delivered. The claims are liquid until they are tested. The moment they are tested, liquidity becomes conditional. Now shift to Europe after World War I, a different currency, different institutions, but the same mechanism. The setup was the post-war order and the attempt to reconstruct a gold-linked credibility system with economies that were physically and socially damaged. Germany carried the burden of reparations as dictated by the Treaty of Versailles. The foundation was supposed to be fiscal discipline and restored confidence, but the reality was a broken productive base, political instability, and external obligations that were hard to meet in real terms. Then came expansion and debasement, not always as an intentional scam, but as a survival strategy. To meet domestic obligations and cope with a collapsing economy, the state leaned into money creation and credit expansion. The idea was to bridge an impossible gap. Real resources were scarce, yet nominal obligations were fixed. As the expansion continued, the currency became the shock absorber. The mechanism moved into crisis. Prices rose rapidly. The public's behavior changed because the unit of account was no longer trusted. Wages were paid and spent immediately. Savings evaporated. Foreign exchange became a battleground. And when a currency weakens, import prices rise, feeding inflation, which then weakens the currency further, a transmission loop that becomes self-reinforcing. That is inflation transmission in its purest form. Not a policy debate, but a lived constraint. And just like in the US case, the question of control becomes a trap. Tighten money to defend the currency, and you break the economy and the banking system. Ease money to support activity and fiscal needs, and you accelerate the currency's loss of purchasing power. The system becomes a choice between two types of pain. The outcome in Germany's hyperinflation era was a full reset of the relationship between claims and collateral. The old unit died in practice before it died on paper. A new unit was introduced, backed by a different credibility structure, and, crucially, by constraints that were more believable. What does this have to do with silver crashing from $80 to $75? Everything, because the metal is not the driver, it is the sensor. In both case studies, the real story was the integrity of the unit and the credibility of the collateral behind promises. Precious metals are where the market goes when it wants a balance sheet asset that is not someone else's liability. But that does not mean metals rise in a straight line. Metals trade inside the same liquidity system as everything else, especially in the modern world where futures, options, ETFs, and structured products dominate the price most people see. In a tightening dollar regime, the paper market is forced to behave like a leveraged asset class. Margin requirements rise, volatility increases, dealers reduce balance sheet usage, funding costs climb. When funding costs climb, carry trades die. And when carry trades die, forced selling appears in places that seem unrelated. Silver gets hit because it is volatile, because it is smaller than gold, and because it sits at the intersection of monetary fear and industrial cyclicality. If the market starts to price deflationary pressure, meaning collapsing demand, tight credit, falling velocity, silver can be sold as an industrial commodity even while the long-term monetary case remains intact. This is where the paper versus physical distinction stops being a slogan and becomes a mechanism. Paper silver can be created in volume. Futures contracts, unallocated accounts, ETF shares. Physical silver must be mined, refined, assayed, and delivered. Those are different timelines, different frictions, different constraints. In normal conditions, the link between paper and physical is maintained by arbitrage and confidence. The futures curve, the lease rates, the willingness of participants to make markets, the availability of inventory in registered categories, the smooth flow of collateral and repo and FX swap markets. These are the boring plumbing lines that keep the screen price connected to the real metal. When the dollar machine tightens, the plumbing clogs. Balance sheet becomes scarce. Risk-free collateral stops feeling free. The cost of carrying inventory rises. Suddenly, a dealer who used to warehouse metal and finance it cheaply doesn't want to or can't. And that's when you can see physical premiums appear even as screen prices fall because the market is splitting into two. The leveraged paper market, clearing at the price required to force liquidation, and the physical market clearing at a premium reflecting delivery friction and scarcity of immediate supply. Gold behaves differently from silver in that environment, but it is not immune. Gold is the monetary metal with the deepest liquidity, and it is held by central banks, institutions, and sovereigns in a way silver typically isn't. In dollar stress episodes, gold can initially be sold to raise dollars, because in a funding squeeze, the only thing that matters is obtaining the settlement unit. That's why you can see gold drop in the opening act of a crisis, even if the crisis is fundamentally about monetary credibility. Silver, being thinner and more volatile, often suffers more in that opening act. The market is not voting on truth. It is meeting margin calls. It is meeting collateral demands. It is meeting redemption flows. It is responding to the invisible pressure of funding markets and FX hedging costs that most retail charts never show. Watch the bond market, because the bond market is the mirror of the dollar system. When yields rise sharply, it can mean inflation expectations are rising, or it can mean real rates are rising because liquidity is being withdrawn and the market is demanding a higher return for holding duration risk. The auction calendar becomes a stress test. In stable times, auctions clear with modest concessions and strong demand. In stress times, primary dealers absorb inventory and then try to distribute it, but distribution requires balance sheet and risk appetite. If both are scarce, dealers demand more yield. That pushes yields up further. Higher yields tighten financial conditions. Tighter conditions stress equities and credit. Credit stress increases volatility. Higher volatility increases margin. Higher margin triggers forced selling. Forced selling hits liquid assets first, because that's what can be sold immediately. Metals futures are liquid. ETFs are liquid. They become sources of cash. And so a silver crash can be the downstream consequence of a Treasury auction tail, a spike in funding spreads, or a disorderly move in FX that increases hedging costs for global investors. FX stress is the transmission line that ties all of this together. The dollar is not just a currency, it is a funding instrument for the world. Corporations borrow in dollars, banks borrow in dollars, sovereigns borrow in dollars, traders hedge in dollars. When the dollar strengthens rapidly, it increases the local currency burden of dollar debt. That can force deleveraging abroad, which feeds back into global risk sentiment and asset selling. When the dollar weakens sharply because liquidity is injected, it can transmit inflation through import prices and commodity channels. Either way, the dollar is the pivot and the system swings around it. That is why inflation versus deflation is not a simple yes or no question. It is often sequential. You can have a deflationary liquidity squeeze that crashes leveraged assets, followed by inflationary policy responses that reflate nominal prices. The sequence matters. The timing matters. The market can destroy you in the deflationary phase and then prove your long-term thesis correct after you're already out of the game. That is the cruelty of this machine. So when you see silver get wiped from $83 to $75, the wrong interpretation is silver fundamentals changed overnight. The right interpretation is that the global collateral and funding engine tightened, and silver was one of the most efficient pressure release valves. The price didn't just move, it was pushed. The resistance level didn't just crush everyone because lines on a chart have magical power. It crushed everyone because the structure above that level was built on leverage, and leverage breaks at predictable points when volatility rises and liquidity recedes. Resistance is often just the chart's way of showing where the marginal buyer is balance sheet constrained. History teaches the same lesson in different accents. Under Bretton Woods, the constraint was gold convertibility. Under interwar European stress, the constraint was external obligations and collapsing real capacity. In both cases, expansion of promises ran ahead of the foundation, crisis revealed the mismatch, and the outcome was a repricing that punished anyone who thought the old regime would hold forever. The modern regime has its own foundation. The dollar's role in global settlement, the Treasury market as collateral, and a network of funding markets that allow leverage to be carried. It feels permanent until it doesn't. And here is the ominous bridge we have to confront. The metal crash you just watched is not the end of the story. It is the early symptom that the foundation is being tested in the only place that cannot lie for long, the plumbing that decides whether the world gets dollars smoothly or gets them with pain. The pattern completes, yields, volatility, and the precious metals. Stress valve that can't stay closed. That plumbing test has a name in real time. Who gets dollars smoothly and who gets them at a penalty? When the penalty shows up, it doesn't announce itself with a headline. It appears as small distortions that professionals notice first, hedge costs that jump, repo terms that tighten, swap spreads that twist, auctions that clear, but only after price is forced to do the work policy used to do. And once those distortions appear, the mechanism you've now seen twice in history doesn't need permission to proceed. It proceeds because incentives and constraints make it proceed. The third proof point is the late 1990s into 1998. the Asian financial crisis, bleeding into Russia's default, and then detonating long-term capital management. Different era, same machinery, reserve currency funding, leverage built on assumed liquidity, and then a sudden re-rating of collateral and counterparty risk. The setup was the post-Cold War confidence regime, liberalization, capital inflows, pegs and managed currency bans across parts of Asia, and an emerging market growth miracle financed by foreign currency liabilities. In Thailand, Indonesia, South Korea, and others, corporates and banks borrowed heavily in dollars because dollar funding looked cheap and stable. They earned in local currency and assumed the exchange rate would remain anchored. The foundation was the peg credibility plus abundant global liquidity, with the dollar as the settlement unit for trade and debt. Then came expansion. Capital poured into these economies. Credit growth surged. Real estate and corporate leverage inflated, and maturity mismatches became structural, short-term dollar liabilities funding long-term local projects. At the same time, the US and global investors were engineering sophistication on top of that foundation. Derivatives, swaps, leverage on leverage. By the mid-1990s, the world had built an elegant machine that assumed one thing above all: the ability to roll funding without friction. That assumption is always where the math hides. When rollability is treated as permanent, the system becomes a single trade: short volatility, long liquidity. The crisis phase began when pegs and credibility cracked under external imbalances and speculative pressure. Thailand devalued in 1997. The contagion moved across the region. A weakening currency instantly increased the local currency value of dollar debts. That is, inflation transmission and balance sheet deflation at the same time. Imported prices rise, while real debt burdens explode. Corporates and banks scramble for dollars to service liabilities, selling local assets, cutting investment, and accelerating contraction. It's not confidence in the abstract. It's a forced search for settlement currency. The more they search, the stronger the dollar tends to get in stress, and the more vicious the loot becomes. Then, 1998 arrives and reveals how global and interconnected the mechanism is. Russia defaults on domestic debt and devalues the ruble in August 1998. Suddenly, risk models that assumed liquidity in sovereign bonds were exposed as fantasy. Spreads blew out. Correlations that were assumed stable snapped. Long-term capital management, an emblem of leverage and efficient convergence, found itself trapped. The trades were right in a long-run theoretical sense, but the funding and collateral assumptions were wrong in the only time frame that matters. Now, counterparties demanded margin. Repo became less available. Dealers widened haircuts. The system moved from pricing risk to a rationing balance sheet. The Federal Reserve organized a private sector rescue because the issue wasn't a single fund, it was the pipes. If the pipes broke, everything priced in dollars would reprice violently. The inevitable outcome was a forced deleveraging that spread across markets, proving that reserve currency liquidity is not a background condition. It is a variable, and when it becomes scarce, it behaves like gravity. That case study matters because it looks modern. It's not ancient gold standards or wartime reconstruction. It's derivatives, pegs, cross-border flows, repo, margin, and liquidity as a tradable commodity. It shows exactly how the mechanism completes. A stable foundation encourages expansion. Expansion breeds hidden mismatches. Crisis reveals those mismatches through funding and FX. Outcome forces repricing and resets who survives. Now take that mechanism and lay it directly over today's system, step by step, without romance. The setup today is the dollar system as global operating system. Trade, commodities, offshore lending, and reserve management still root through the dollar and dollar-like collateral. The Treasury market functions as the core collateral pool for everything from money market funds to derivatives margining. The risk-free curve is not just a benchmark, it is the chassis on which leverage rides. When that chassis is smooth, risk assets levitate. When that chassis buckles, everything shakes. Check. Expansion today has been the multi-decade growth of debt and balance sheets that outran organic cash flows. Sovereign deficits rolled into structural dependence on constant refinancing. Corporate leverage became normalized, particularly when policy rates were near zero and term premia were suppressed. The private sector learned the same habit as the public sector: borrow short, roll often, and assume liquidity as a utility. The global system also expanded synthetic exposure, ETFs, swaps, futures, options, so that ownership of assets often means holding a claim financed through collateral chains rather than holding the thing. That's not moral judgment. It's a description of the architecture. Verified. Now the crisis phase in a modern reserve currency regime has a specific signature: the collision between refinancing needs and the price of capital. Debt rollovers become a market event. Auctions become a referendum. The term premium, compensation investors demand for holding long duration, reasserts itself. If the market believes fiscal supply is relentless and inflation uncertainty is sticky, it demands yield. Higher yields then tighten conditions, and the cycle feeds itself through funding markets. Watch the auction details, bid-to-cover ratios, the size of dealer takedown, and whether auctions tail relative to when issued yields. A strong auction with healthy bid-to-cover and low tail suggests demand is absorbing supply without stress. A weak auction, lower bid-to-cover, higher tail, heavier dealer absorption, suggests the market is forcing price concessions to clear. That's not just sentiment, that is the collateral base repricing. Undeniable. As yields rise or become unstable, the funding ecosystem reacts. Repo rates can spike around collateral scarcity, quarter-end balance sheet constraints, or sudden risk-off events. Haircuts increase. Term funding becomes more expensive. Swap spreads, reflecting the relationship between Treasury yields and interest rate swaps, can widen or invert in ways that signal balance sheet stress, hedging demand, or dislocations between cash and derivatives markets. Real yields in particular matter for metals. When real yields rise because inflation expectations fall faster than nominal yields, or because term premium rises, the opportunity cost of holding non-yielding assets increases in the paper market. That can pressure gold and silver on screens, even if the underlying reason is systemic stress. Check. Now layer in FX and global currency stress. In a dollar tightening phase, dollar funding becomes scarce globally, and the dollar tends to strengthen against weaker currencies, not because the US is healthy, but because the settlement unit becomes the scarce commodity. That strength exports deflationary pressure. Local currencies weaken, imported costs rise, central banks tighten defensively or burn reserves, and domestic liquidity contracts. At the same time, for dollar borrowers outside the US, the effective debt burden increases in local terms, forcing deleveraging. This is how a US rates story becomes a global recession impulse. FX basis, the cost embedded in swapping one currency into dollars, can widen when dollar funding stress rises. When the basis widens, it is literally the market charging a premium for dollars. That premium is the invisible tax on the world. Verified. Then comes volatility. Volatility is not merely fear, it is a margin requirement. When volatility rises, clearinghouses and prime brokers increase margin. When margin rises, leverage positions must be reduced or financed at higher cost. The basis trade becomes relevant here. Leveraged funds that buy cash treasuries and hedge with futures, harvesting small spreads, rely on stable repo funding and stable futures basis. When volatility spikes or repo tightens, the basis can blow out, forcing unwinds. That means selling treasuries into a market that already demands higher yields, which can perversely push yields higher in a risk-off moment. That is why modern crises can look illogical on a chart. The logic lives in financing, not in macro narratives. When those unwind cascades begin, the system hunts for liquidity like a predator. It sells what it can, not what it should. Undeniable. Now bring it to risk assets. As financing costs rise and liquidity drains, equities and credit reprice, credit spreads widen because the market starts pricing refinancing risk and default probability. HY and levered loans feel it first, then IG. Equity volatility rises, and systematic strategies reduce exposure. The VIX is not just a number, it's a switch that tells vol-controlled funds how much to own. When it flips, it forces selling. And in the background, the dollar remains the settlement demand. The system becomes a loop. Tighter dollars, weaker foreign currencies, tighter foreign conditions, weaker growth, weaker earnings, wider spreads, higher volatility, more margin, more forced selling, more dollar demand. Check. Now we arrive where you started. Silver and gold as stress valves. In the paper market, metals are traded like leveraged financial assets. Futures and options dominate short-term pricing. ETFs provide instant liquidity. When the system demands dollars, metals can be sold to meet cash needs. Silver, with higher volatility and thinner liquidity than gold, often gets hit harder during the liquidation wave. That explains the brutality of $83 to $75. It is the screen price clearing a forced deleveraging moment. But the physical market follows different rules and different clocks. Physical metal is constrained by refining capacity, minting capacity, transport, and inventory availability in deliverable form. Warehouse stocks can draw down, registered inventories can tighten, and premiums can rise even while futures fall. This is the split between paper and physical that matters most during stress. Paper clears at the price required to liquidate leverage. Physical clears at the price required to part with real metal now. Verified. Look at delivery mechanics. Futures are designed to be financially settled most of the time, with delivery as a discipline mechanism. When stress rises, more participants care about the delivery option, either as a hedge against counterparty risk or as a way to secure inventory. If inventories in key depositories are drawing down, or if the market senses that immediate availability is constrained, nearby contracts can tighten relative to deferred ones. Backwardation risk rises, lease rates can move, Premiums for coins and bars can widen because retail and small wholesale supply chains are less elastic than paper. And because silver is bulky and industrial demand is meaningful, supply can't just be invented the way paper exposure can. Mine supply responds slowly. Recycling responds with lags and depends on price and economic conditions. If industrial demand weakens in a deflationary impulse, it can pressure silver until monetary stress flips the incentive back toward hoarding and delivery preference. That is why silver is a stress valve. It is pulled in two directions by the same dollar mechanism, depending on which phase dominates. Undeniable. Gold's role is cleaner, but still subject to the same financing realities. Central bank buying can provide a structural bid, but the paper market can still experience liquidation under dollar stress. Real yields matter. The dollar matters. But the deeper truth is that gold is the asset the system reaches for when credibility is questioned, yet the system can still force it down temporarily when it needs immediate settlement liquidity. That is not contradiction. That is sequence. First comes the squeeze, then comes the response. And the response can be policy easing, liquidity facilities, balance sheet expansion, or some form of financial repression that tries to cap yields and restore rollability. That response can reignite inflation transmission, weaken the currency, and send capital back into metals as the market reprices the long-term integrity of the unit. The machine is capable of producing deflationary crashes and inflationary aftershocks within the same narrative arc. Check. So, what do you do with this, practically, before the chart tells you too late? You stop worshiping the daily candle and start watching the pipes. Track Treasury auction quality, bid to cover, tails, indirect bidder strength, and dealer takedown. Track term premium and real yields. If real yields are rising because liquidity is being withdrawn and uncertainty is being priced, metals can get pressured even if the long-term case is strengthening. Track funding stress indicators, repo volatility, software dynamics, and signs of balance sheet scarcity around quarter ends. Track FX basis and broad dollar strength. The dollar's role as funding currency tells you when the world is being forced to deleverage. Track swap spreads and credit spreads. They're early warnings that the market is rationing risk and collateral. And for metals specifically, watch the split. If screen prices fall while physical premiums rise and inventories draw down, that is a message about leverage and delivery friction, not weak demand. Verified. How do you avoid becoming the liquidity exit? You respect sequence. You assume the system can force liquidation before it rewards the correct thesis. You don't over-leverage positions that require calm funding conditions to survive. You size so you can endure volatility without being sold out by margin rules you don't control. You separate paper exposure from physical reality in your mind. Paper is a trading instrument inside the dollar machine. Physical is an asset outside counterparty chains, but with its own liquidity constraints. You also stop looking for comfort in slogans. American exceptionalism doesn't repeal refinancing math. Tech will save us doesn't change bid to cover ratios. Modern optimism doesn't eliminate collateral scarcity or the political limits of austerity. Undeniable. This time is not different. The mechanism is older than any administration, bigger than any narrative, and indifferent to your confidence. The dollar system can tighten and break leverage, and it can also be reflated in ways that transmit inflation through currencies and commodities. Both outcomes can happen in sequence because policymakers are trapped between defending the unit and defending the system that uses the unit. Your job is not to predict headlines. Your job is to read the stress signals early and avoid being forced to sell at the exact moment the system extracts liquidity from the weakest hands. If you want to stay ahead of this, stay with the plumbing. Auctions, funding, basis, spreads, real yields, FX stress, and the paper-physical split in metals. The next stage is about how the machine was built to make these outcomes inevitable, and how the pivot point arrives when policymakers choose which constraint to violate first. In the end, the verdict is simple. The silver crash wasn't the story, it was the symptom, and the symptom is telling you the dollar machine is moving into its decisive phase. Are you watching the pipes, or are you staring at the price?